All right. Hi, everyone. Thanks for joining us over your lunch hour. We're excited to talk through both mega cap investing as well as tax management and tax loss harvesting. So, to do quick introductions, my name is Kyle Birmingham. I am a portfolio manager at Quorus, and we provide custom SMA, direct indexing, and tax management for financial advisors. And really excited to have Lee Eichel here with us as well. Lee is CEO of Alpha
Thank you.
V. He has been one of the early supporters for us in terms of direct indexing and thinking about active strategies in direct indexing. So we're really excited to have him here today to talk through the mega cap strategy that Alpha V runs. And then I'll spend a little bit of time talking about what we're doing at Quorus with his strategies and how we're running them in tax efficient, tax optimized ways. So Lee, I will turn the floor over to you. You can introduce yourself, and then we can start talking a little bit about Alpha V's mega cap strategy, which, spoiler alert, is crushing it this year.
Thanks, Kyle, so much, and thanks for the time, and everyone. The obligatory disclosure. So today we're going to focus. Alpha V has a pretty unique system. We do old school, boring fundamental analysis and research, and build a number of interesting portfolios. You can see them all on alphav.com. Today we're going to look at our mega cap strategy. Keep on rolling. Alpha V, for those of you that may not know us so well, we've been leading the way over the last number of years. We're best known for our risk management strategies. We get into a lot of different kinds of research. Again, today we'll focus on the mega cap, but suffice to say, when you download the slides and go through it, we do have a blend of qualitative and quantitative research. Everything's kept up to date, and it's probably one of the most modern portfolio construction methods that you'll find out there that's deployed in our company. So just, a quick history on us, and we're gonna, I want to spend most of the time actually talking about the strategy, but I wanted to include this because, again, not a lot of people know us. We've been white labeled on ETFs back in 2015 with a major asset manager. We're a 12-year-old company. We're a global company with offices in Israel and throughout the US. And excited about the partnership with Quorus. Number of impressive strategies, including the US Mega Cap, which is up over 37% year to date. And it's been the number one strategy on a lot of platforms all year long. And this isn't the first year. As you saw in the previous slide, some of the awards that we were won, when you look closely, also the Alpha V US Mega Cap strategy. So I always like to talk a little bit about risk. Being a risk managed oriented company, and a lot of our models, a lot of our AUM is in risk managed research and portfolios tied to that research. Risk is not an on-off thing. My skin crawls whenever I hear about someone saying is risk on, risk off. Risk is variable. There's always risk. The question is, how much risk is there in the market? This is really, though this is a presentation for financial professionals, this kind of information is customer facing kind of chart to just drill that point home that patience is rewarded. Optimizing the alpha side, yes, is important, but no less important than optimizing the beta side. So it's finding that yin and the yang, the balance between the two, knowing when it's a growth time, when it's a defensive time, or actually I'd consider mega cap companies to be defensive growth companies, which might sound like an oxymoron to some of you, but I'm going to make that case in this presentation just coming up now. So there's been significant outperformance again. Let's dive into it at a high level. The strategy, mega cap strategy itself, it's systematic, it's robust, it's rules-based. There's 15 companies that we're going to select out of the mega cap segment, and that mega cap segment is $50 billion or greater, and that's over 70% of the market capitalization of the market. It's a pretty these are all very impressive companies. And we grade these companies to meet the eligibility criteria. We'll get into it in more depth, but they're stable revenue, good income growth, low leverage, good momentum, and stable return series, essentially. We weight all the stocks based on their free float market capitalization, and we're going to rebalance or reconstitute this portfolio every 90 days. Continue. So over time, how has our approach done? Let's just cut to the facts. And again, I'm going into a fair amount of depth. There's a lot of proprietary signals and research that we do constantly to achieve this. But in this case,
oh, it looks like we lost Lee here. We'll give him a second to reconnect.
Sorry about that. Got kicked out for a second. So in this case, for this portfolio, you can see we're achieving, above market standard deviation. This is from January 2010 forward, above market compound returns, significant, with a little more standard deviation. So in this case, we're accepting a little more standard deviation to achieve that outperformance. And again, the rest of the numbers will speak for themselves in a minute. If you'd continue. Now, I always say CAGR builds your business as an advisor, and that's true. You can see the annualized return. Having a year-to-date performance of 37.61%, that was as of, I believe it was yesterday's close or the day before's close. There's 15 positions. It's generally a $40,000 account minimum. And we can see over time how it's done. Let's go on to the next slide. But I'd like to point out is also how much volatility is there in the returns. So live performance numbers from 2019 for this portfolio going forward, sure, you can stare at the year-to-date column all the way to the right, but it's also important to look at the down months and where that variability is, because there is some standard deviation in this kind of portfolio. But it's been a consistent, very, very strong performer. 2022 was a tough for many companies, especially in this segment. So it's also important that we talk about when it doesn't tend to work, why it works and why it may not work. Continue. So what we see here in comparison, our approach, and we're going to drill into it a little bit more. There are other mega cap portfolios out there to get the exposure, and we can see them here on the right and how they've done year to date. This is as of current closes. And this one has significantly outperformed, the best one out there, which is the Vanguard, by a great margin. Continue. So why? Well, there's 15 positions. Some of these other portfolios have hundreds of positions. Does that 15 mean a little more volatility? Yes. Does it add a little bit more concentration risk? Not so much as you would think, based on the weightings and when you really peel back the onion, the way how other people also manage the portfolios. So what we're looking for is good, solid quality and companies, good value. So you can see revenue growth, income growth, relative strength, debt to equity, all important characteristics, and the stability of those returns are very, very, very important in how we think about it and look at the companies that end up finally in the portfolio. And patient investors and the firms will benefit from having companies that have very strong balance sheets. Think about these mega cap companies, very professional management teams, lots of corporate oversight, and this year, maybe more important than anything, significant international revenue is part of those companies. Continue. So what kind of companies are we talking about? So immediately when I say mega cap, a lot of people think, FANG stocks. So sure, there is Microsoft, there is Facebook or Meta on there. But look at the top companies. We have Advanced Micro Device. Yeah, it's a tech company. It's semiconductor oriented. But Costco, wholesale, retail company. What about Monster Beverage? Synopsys, a semiconductor software oriented company. So there's a variety of companies that come into the portfolio. I just took the top ones and their percent return this quarter, how we've done. So quite good. And again, if I put up the rest, you'd see some negatives creeping in, but we can see the top ones doing quite well yet again this quarter. Now, one question people bring up: are these normally defensive companies or growth companies in this market, which trades sideways, which there aren't a lot of opportunities? I call it both. This is where I say you can be a growth company and defensive. The market is rewarding these companies for their balance sheets, for that case that I made, for their international revenue components, and you can think about international sales on all of these companies. And if you, again, peel back the onion, you'll see a lot of international exposure, getting that revenue from outside the U.S., also good. Diversification across segments, also very good. So I'd call it defensive growth oriented is the Alpha V US Mega Cap. Continue on. So you can follow the results. This, even though it's in SMA format, Alpha V is a huge believer in transparency in all of our research and investing and with our investing partners. You can go to cboe.com, look up the Alpha V US Mega Cap, track the performance there. You'll also find we document our buy side and sell side discipline. Followed on Morningstar, you have the Morningstar ID, and it's available for allocations on a number of platforms, of course. So thanks again, and I'll turn it back over to you, Kyle.
Awesome. Thank you, Lee. And I'll spend a bit of time talking about Quorus, who we are, and what we do, in particular, direct indexing and custom SMA with tax optimization. And then want to talk through specifically what we're seeing with Lee's strategy, the mega cap strategy, how it's performing in a tax optimized way, and talk through a little bit of the anatomy of a TLH trade, because I think it's actually simpler than a lot of folks think. So just a bit of background on Quorus. We were founded in 2022 by an experienced team. John, our CEO, spent time at Vanguard, Antigas, Scott, our CTO, time at a number of top financial services company, and myself, background at Vanguard, Composer, which is an automated retail trading platform. So we come at this problem from industry, and we're also backed by blue chip venture capital. So good support, good founding team, and John and myself are both CFAs, and we run the portfolios here at Quorus. How we think about the world is that your portfolios, the way advisors like to build portfolios, is very personal to them. They have personal views on how, whether they like indexing, whether they like active, whether they like value strategies. And we think that that variation is great, and you should be able to express your own views in the portfolio. But one thing that everyone can benefit from is tax optimization and more personalization for their clients. And so when we say direct indexing, when we say custom SMAs, we really mean the same thing, which is running portfolios at a ticker level so that you can customize and tax loss harvest for your clients. And there's three really big benefits that you get when you do that. First is you can increase after-tax returns for your clients. I hate paying taxes. Clients hate paying taxes, right? They shouldn't have tax bills at the end of the year if you can avoid it. And the great thing about tax optimization is that it's much more durable than market return or manager alpha. Taxes are a known entity, right? Death and taxes, what the tax rate for a client will be. In general what their income profile looks like. And so you can manage to that and take what the market gives you in a given year to try and reduce that tax bill. And you can do that both in up markets and down markets. The second piece that's really beneficial for direct indexers and running custom SMAs, particularly with Quorus, is that you as an advisor can reduce your operational complexity. We are discretionary portfolio managers. We connect directly to your custodian and trade your accounts for tax losses, for religious values, and make sure that's done on a daily basis, removing that burden of you trying to do tax-aware rebalancing, tax-aware trading in any of your taxable accounts for clients. So it can really reduce the time you spend trading client accounts. And lastly, you can customize at the ticker level, whether that's religious values, whether that's ESG screens, or completion portfolios for your clients. They have large positions from ESOPs, or they were gifted shares from their parents. You can build portfolios around those positions when you're looking at individual tickers. To provide an example, we're working right now with a financial advisor who's trying to win the business of a client who has strong evangelical values. She has a huge portfolio of private REITs, and she has a decent income profile from her other investments. And so we're actually modeling an account where we've removed REITs, we've overlaid a evangelical screen to screen out companies, and we're now running that portfolio for this advisor so they can take it to their finals meeting with this client and show what they can do for that client to win business for them. So when we talk about tax alpha, how much are we talking about? Well, it depends on client profiles. I won't say that every client can earn 200 basis points a year in tax alpha, because that's unrealistic. What we see in the research is that 60% of tax alpha is driven by the client profile. So the client's portfolio size, income, how many capital gains they generate, and 40% is generated by the market. So what market returns look like, what volatility looks like. So here you see a couple of income bands and what the estimated tax alpha is for those clients. And you can see, on the lower end of what I would consider a wealthy individual, earning $130,000, there's still significant tax alpha to be had for that client, 24 basis points per year. But as you move up towards your higher net worth clients, you're almost looking at 2% additional gains, that be additional return that can be earned by these clients by managing for taxes. And that's why we think there's a ton of value here for advisors that can deliver this for their clients and show this on a year-over-year basis. Think about how your retention will improve. Think about how your ability to win new business if you can show clients you're delivering this and other advisors are not. And something we think a lot about is, how do you optimize around tax loss harvesting? How do you deliver the most value for the client? And what we found is that there's two things that really matter. One is you need to do this on a daily basis, right? You need to look at your account and all of the tax lots in your account every single day. And we talk to advisors who say, hey, I tax loss harvest on a quarterly basis, or I tax loss harvest, at the end of every month. And while that's great, while you're delivering value for your clients, there's a lot more you can be doing if you were looking daily. And so that's how we manage our portfolios. We look every single day across all of the tax lots, and we will harvest those losses when possible, because markets don't follow a calendar schedule. The second thing that's really important with tax loss harvesting is having individual tickers that you can trade, right? Individual tickers that you can harvest when they fall. So the bottom chart here is showing the delta between ETF tax loss harvesting and individual ticker tax loss harvesting. It's roughly 30 basis points on average of additional alpha that you can generate when trading individual securities. So that's why we really say daily and individual securities are the best way to tax loss harvest. So when we first started working with Lee, we decided to run a few of his strategies through our platform to show clients, hey, what is possible with both really good active management and tax optimization. So we started running the US Mega Cap strategy in early May. It's a $500,000 account, and we've set it up for aggressive tax loss harvesting. As Lee mentioned, the strategy is doing phenomenally well year to date. Since we've been running the strategy, it's up almost 13%, but we've still found opportunities to harvest losses within that portfolio. And so that's what I want to talk about a little bit. So let's take a look at that strategy. I'm going to pull up the Quorus platform here. So what you can see here is the Quorus platform and the Alpha V US Mega Cap strategy. So as I said, we started at a little over 500,000, up significantly from there. We have the 15 holdings here. And you can see that despite being up almost 13% in a month, we've still harvested, $173 of capital gains. Feels like a small number, but remember, this is during an incredibly strong performance stretch. And we've been running it for a month. We'll show, we haven't realized any capital gains, and you can see the tracking error for this strategy. I'd say the tracking error here is a bit on the high side. Again, been running it for about a month. And you also see with strategies with a fewer number of holdings, slightly elevated tracking error, but it's still within the range that we would expect for these strategies, anywhere from 75 to 275 basis points of tracking error, depending on how many holdings and how much customization you want to put on the portfolio. And so if you look at the sector breakdown of this strategy, both the holdings, what the strategy is dictating this, the Alpha V US Mega Cap, the bottom line here versus what we are holding at this given point. You can see a slight underweight to healthcare. And that's because of the tax loss harvesting trades that we've made in this account. And so if you scroll down past the current holdings and you look at the trade history, you can see that we had the opportunity to harvest losses in two names, Moderna and Vertex. And so that's why we were slightly underweight healthcare within this portfolio. But let's look at what these trades actually look like to give you a sense of how we're managing these accounts on a daily basis. So what's the anatomy of a TLH trade? And like I said, this is much simpler than many people expect. So on the 18th of May, we came in and got notified with our account optimization or our portfolio optimization service that, hey, Vertex has, fallen from, when we bought it. There's a loss of $93 in that name. We sold about $3,000 of notional out of that name. And then our approach, we sort of peanut buttered that across the rest of the portfolio, right? We identified 9 other securities that were available to purchase. They weren't too far overweight. They weren't protected by wash sale rule. Said, hey, we can buy these 9 names to put that money to work. So the way we think about it is we want people to be invested, right? We don't sit in cash after we harvest a loss and get back in 31 days later. We put that money to work back into the portfolio. All of the hard work that Lee and his team have done to identify which securities to own, we want to make sure clients are invested in those names, right? So we put that money back to work across the portfolio. And then every single day, we're looking at this account and saying, hey, is there another TLH trade that we can make? Hey, has the performance shifted the portfolio too far from target? Do we need to rebalance back to the target weights that Lee and team set? And the benefit here of doing this is that anytime you rebalance, anytime you make a tax loss harvesting trade, you're resetting cost basis, right? So that $3,000 that we put to work across Meta and Costco and Intuit, that's at a new cost basis for those names, right? Which give you that opportunity to harvest potentially future losses. It's a sort of a beneficial cycle each time you make a tax loss harvesting trade. So that's what's been happening within the Mega Cap portfolio that we've been running on Quorus. We've had the opportunity to harvest some losses in some names while also still delivering really strong performance that Lee and team have generated with their intellectual property. So if you're interested in tax loss harvesting, if you're interested in running an Alpha V strategy in a tax optimized way, reach out to us, sales@quorus.io. We'd be happy to model an account specifically for you. If you're interested in back testing some of these strategies in a tax optimized way, we can do that for you as well. We'd love to talk to you about your portfolios and what you're looking to accomplish. And I know if you have questions for Lee and team, I believe it's info@alphavee.com. You can also get additional details there. Looks like we had a few questions come in, so we can jump to these real quick. So from Frank, how much tracking error does tax loss harvesting create in an account typically? So as I mentioned, it's going to depend a bit on how many tickers are in the account, as well as how much customization you've put on the account, right? So if you put evangelical screens or ESG screens, you're going to introduce more tracking error into the account. I'd say on the low end, you can expect around 75 basis points for tax loss harvesting in terms of how much tracking error you'd create. On the higher end, you're looking at almost 3% or 300 basis points of tracking error, and that would be, fewer holdings and potentially significant customizations on ESG screens or religious value screens. Question here from Luke. What would happen if all 15 stocks sustain losses in a sharp market correction? Luke, great question. And this is something we think about with our portfolio optimization when we're looking at potential TLH trades. So if there's a sharp market correction, we would get sort of think of it as like a line item list of all the potential tax loss harvesting trades we could make in that account. What we then do before we execute any tax loss harvesting trades is we look at how much of the portfolio is available to buy. So, what stocks are locked out because of wash sale rules, what stocks are locked out because they're already too overweight within the portfolio and we don't want to add to them anymore. And we say, okay, how much of the portfolio is able to buy? So, for example, we think we could put $20,000 to work within this Alpha V strategy. We will then go back to our tax lot harvesting trades and say, what's the best $20,000 of notional that we could trade today, so that we can still put that money to work? Because we don't want to ever be in a position where we're selling off more of the portfolio and moving to cash, and we're keeping our clients out of the market when really they should be fully invested. So if there's a scenario of a really steep market correction, we will make what we call the lossiest trades possible, but to keep our investors still fully invested so they don't miss that correction on the back end, or sort of the rebound on the back end of a correction. Again, Lee and team spend a lot of time picking these stocks, and so we want to make sure any client that's selected Alpha V is getting the full value of that intellectual property. They're getting all of those names, and we're just trying to make trades on the margin to be tax optimized. Mm-hmm. Yeah, both great questions. Mm-hmm. Awesome. Well, we're coming up on time here. Thank you, everyone, for joining us. Lee, anything you'd like to say in closing?
Just like to thank you for putting it together. I think it's a good start to a conversation, and I'd like to continue the discussion. I think tax loss harvesting, tax optimization, tax-aware portfolios, multi-asset portfolios with tax loss harvesting are, I think, all good ones for another, to continue this series and continue the discussion.
We love having you.
So thank you.
Love you sharing your insights, as well as how you build portfolios. And I'll just reiterate, if you're interested in having an Alpha V strategy run in a tax optimized way, reach out to us. We'll get on the phone with you. We'll model some things, really show you what we can accomplish together. So thank you, everyone, and have a good rest of your day.
Thanks, Kyle. Thanks, everyone. Take care.